Ever looked at a stock chart, maybe, or crypto prices, and it's just zigzagging all over the place, and you feel like, you're just missing something fundamental?
Oh, absolutely. It can seem like pure noise sometimes. Like, how do you even start to make sense of it? That's a really common feeling.
Yeah, like everyone else gets it. Well, the good news is there are tools, foundational ones, that can help cut through that chaos.
Definitely. And that's what we're going to dig into today.
Exactly. We're putting aside the super complicated stuff for a bit and really zeroing in on a cornerstone tool, the simple moving average. You'll hear it called the SMA.
Right. The SMA. It sounds simple, and, well, the calculation is pretty straightforward. But its power is in how it simplifies that price data.
How does it do that?
Think of it like smoothing out all those little daily bumps and dips in the price. It creates a single line that helps you see the bigger picture, the underlying trend.
Okay, so it helps reveal the direction underneath the noise. And we're not just talking theory here. Our source for this deep dive is actually from the Stock Sniper Trading channel on YouTube. They explain the SMA from a trader's perspective.
hmm So it's practical, real-world application.
Right. So our goal today is pretty clear. Explain what an SMA actually is, how it works in practice, and importantly, what it's good for and what its limits are.
Exactly. We want to give you a solid handle on this basic but really useful tool so you can see how it might fit into, how you look at market movements.
Okay, let's get right into it then. What is a simple moving average? I mean, simple and average seem clear, but what's really going on there?
Well, at its heart, the SMA is a standard indicator. You'll find it on pretty much any trading platform out there.
Okay.
And like the Stock Sniper Trading video points out, its main job is just to make price data easier to read. It averages out prices over a chosen number of past periods. Could be days, hours, minutes.
And plots that average as a single line on the chart.
That's it. It smooths out the raw price fluctuations.
So we often hear about, say, a 20 SMA or a 50 SMA, maybe a 200 SMA. What does that number, that 20 or 50, actually mean?
That number is the look-back period. So a 20-day SMA, for instance, takes the closing prices of the last 20 days,
Okay.
adds them all up, and divides by 20. Simple average.
Right.
A 50 SMA does the exact same thing, just over the last 50 periods. Could be 50 days, 50 hours, whatever the chart's time frame is. You can have a 5-day, a 100-day, a 208-day.
Yeah.
Any length, really.
Got it. So does that mean a shorter time frame, like that 20 SMA, is going to react faster to recent price changes compared to a longer one, like a 100 SMA?
Absolutely. That's a key point the Stock Sniper Trading explanation makes. The longer the period you choose for your SMA.
Like the 100 or 200.
Yeah, exactly. The smoother that line is going to be, it won't jump around with every little price wiggle. It gives you a much broader view of the long-term trend.
Okay, so it filters out more noise.
Right. And conversely, a shorter-term SMA, like a 10 or 20,
Yeah.
well, that's going to stick much closer to the recent price action. It'll be more jagged, more volatile, reacting quicker to shifts.
Okay, that makes sense. So how do traders actually use these lines on their charts? What are they looking for?
Well, one of the primary uses is just identifying the trend.
Yeah.
Is the market generally heading up or down?
How does the SMA show that?
Just the direction of the line itself. If the SMA line is generally sloping upwards, it suggests that, on average, prices have been increasing over that look-back period. That points to bullish momentum.
And if it's sloping down?
Then it suggests a bearish trend. The prices have generally been falling. It's a quick visual clue to the prevailing direction.
Okay, so the angle tells you the trend. The source video also mentioned SMAs acting as support and resistance levels. How does that work?
Yeah, that's a really common application, especially with longer-term SMAs like a 50-day or a 100-day, maybe even the 200-day.
Okay.
In an uptrend, that SMA line can sometimes act like a floor. The price might dip down towards it, find support there, and then bounce back up, resuming the uptrend. The video used the phrase bouncing off of it.
Right, like a dynamic support level.
Exactly. And the reverse is true in a downtrend.
The SMA acts as a ceiling.
Precisely. The price might rally up towards the SMA, hit resistance there, and then turn back down. So traders watch how the price interacts with these key SMA levels. Does it respect them or break through?
Now, this sounds like where potential trading signals might come in. The video talked about crossovers. Can you break that down?
Sure. Crossovers are a popular technique. It involves using two SMAs with different lengths on the same chart. Say, a shorter one like a 10-day and a longer one like a 50-day.
Okay, a fast one and a slow one.
Kind of, yeah. A bullish crossover happens when that shorter-term SMA crosses above the longer-term SMA.
What does that signify?
It's often interpreted as a sign that upward momentum is building. The recent average price is now higher than a longer-term average price. For some, it's a potential signal to buy or enter a long position.
Did the video give an example?
Yes. They showed the 10-day SMA crossing above the 50-day SMA on a Euro GBP chart, coinciding with a move up.
Okay. And a bearish crossover, is that just the opposite?
Exactly the opposite. The shorter-term SMA crosses below the longer-term SMA.
Indicating downside momentum?
Right. It can be seen as a signal that a downtrend might be starting or accelerating. Perhaps a time to sell, exit a long position, or maybe even consider a short position. The Euro GBP example also showed this, the 10-day crossing below the 50-day.
The source video also mentioned using like 3 SMAs together, maybe a 20, 50, and 100-day. What's the thinking there?
Using multiple SMAs lets you see the trend across different time horizons all at once.
Ah, okay, like short, medium, and long-term views together.
Exactly. The 20-day shows the immediate action, the 50-day gives you the intermediate picture, and the 100-day shows the longer-term flow. You can see if they're all aligned, all pointing up or down, which can increase confidence in the trend. Or you might see them conflicting, which could signal uncertainty or potential change.
The stock sniper trading video had those charts with the red and green candles. Just quickly, green means price went up. In that period, red means down.
Yeah, that's standard. Green candle closed higher than it opened bullish.
Yeah.
Red candle closed lower than it opened bearish.
Okay. And they had the SMAs overlaid, yellow for the 20-day, blue for the 50-day, and green for the 100-day, I think. What did that visualization show?
Well, one thing that really stood out was how that green line, the 100-day SMA, was much smoother. It moved more slowly, kind of parallel to the overall price direction.
Because it's averaging over a longer period.
Right. It filters out a lot of the short-term noise. But the yellow line, the 20-day, was much closer to the price action, reacting more quickly, showing more ups and downs.
And they mentioned price being above or below the lines having meaning?
Generally, yes.
Mhm.
When the price is consistently trading above an SMA, especially the shorter or medium-term ones like the 20 or 50, it's often viewed as bullish. It suggests buyers are generally in control over that period. Conversely, price action consistently below an SMA tends to be seen as bearish.
Then they walked through that Euro GBP chart example on the 60-minute time frame. Seeing the 10-day and 50-day interact was helpful.
It really was. You saw that initial bearish crossover. The 10-day yellow line dipped below the 50-day blue line.
Right.
And the price did move down afterward. But then, price found some support, bounced a bit, even poked above the 10-day line briefly.
Yeah, showing some buying interest maybe.
Potentially. And then came the bullish crossover. The yellow line went back above the blue line.
And the price moved up again. But it wasn't perfect, right? Because the price then fell back below the 10-day line not long after.
Exactly. And that's such a crucial point. No indicator is magic. It doesn't predict the future perfectly.
Right.
We saw the price fluctuate, drop below the 10-day again, which eventually led to another bearish crossover. The example also showed times when the price just chopped sideways between the 10 and 50 SMAs.
Consolidation. No clear trend.
Right. Which leads us perfectly into the limitations. The SMA isn't foolproof. What's the biggest drawback the video mentioned?
The lag, right?
That's the main one. The simple moving average is inherently a lagging indicator.
Because it uses past prices.
Precisely. It's calculated using historical data only. It's always looking in the rearview mirror.
So what's the consequence of that lag?
Well, it means that by the time the SMA generates a signal, like a crossover,
Yeah.
the price move might already be well underway. You might get the signal late.
Or worse.
Or worse, you might get a false signal. The trend might look like it's starting or reversing based on the SMA, but then the price quickly snaps back the other way. This happens. I remember early on chasing an SMA crossover, only to buy near the top right before a drop. That lag can really bite you.
So those clean crossovers you see looking back at a chart might not be so clear or reliable in real-time decision-making.
That's the danger. Because it's based on the past, it might confirm a trend that's already quite mature, or even starting to fizzle out. This leads to what traders call whipsaws, getting signaled in one direction, then immediately getting stopped out or signaled in the other. False signal.
The video also noted that SMAs often work better or are maybe more reliable on higher time frames, like daily or weekly charts, rather than minute charts. Why is that?
Generally, yes. On higher time frames, daily, weekly, monthly, all that short-term erratic price action, the noise, it gets smoothed out much more. The SMA line becomes less choppy, giving you a clearer picture of the significant underlying trend. This means